So why do I use ratio trading for my overnight swing trades? We use ratio trades for our overnight swing trades when we are trading options. And the reason for that is that we need a hedge when we're trading overnight. If you're a day trader, you can place a stop. However, if the market goes the other direction during your overnight swing trade, having a ratio trade in place will allow you to maximize your gains, but also minimize your losses. In the past, I've given my ratio trades names to make it a little bit easier to understand what they are and to talk about the different types of trades. Now, a ratio trade can be 2 to 1, 3 to 1, 4 to 1, so forth. And in the past, I called them SPY T A, B, C, and D, and I'm still calling them by those names. However, I have changed the formula. So now a SPY T A trade is 1 to 1, or a straddle. Then there's the SPY T B trade, which is 2 to 1, SPY T C, 3 to 1, so forth. If your indicator says up, you would buy 2 calls to 1 put. If your indicator said down, well, then you buy 2 puts to 1 call. Buying multiple options can get rather expensive, and there's more than one way to create a ratio trade. So if you want a little bit less expensive trade, and in some ways a little more aggressive trade, you can consider a ratio of the main option. This means if your indicator said up, well, then you would buy a call just in the money, and then a put, say 1/4 the price, which would be a SPY T D R trade. That lowercase r just represents a smaller ratio trade. If you have access to SpyTomorrow.com's probability numbers, and you see that there's a high probability for a direction either up or down the next day, well, then you might want to consider a small directional trade. And in that situation, you would call it a SPY T 0.5 or 0.2 trade for 20% of your portfolio, or 0.05 for 5% of your portfolio. And of course, that's trading in your designated high risk portfolio area, because yes, SPY T trading is high risk, high reward trading. SPY T trading is an overnight swing trade, and at the end of the trading day, we look at our indicator, and we use the SpyTomorrow.com indicator, and say our indicator said up, we would also look at other indicators to support it. We have other algorithms, confidence numbers, the probability numbers, and I'll take a look at those numbers to decide how aggressive I want to be overnight. Do I want to, say, consider a SPY T C trade, which is a 3 to 1 options ratio, which is more conservative than a SPY T F trade, which is 6 to 1 options ratio. Personally, I'm most comfortable with the SPY T C R and SPY T D R trades, which are 3 and 4 to 1 options ratios. So last night, my indicator said up, so I decided to do a SPY T D R trade, which means I bought a call just in the money and then a put 1/4 of the price. The more conservative trades, such as the SPY T A, which is basically a straddle, or a SPY T B 2 to 1 trade, isn't always the best move because you need much more of a market move for it to work. So you need to consider stocks or ETFs which have a much higher volatility, such as an IV over 20, before you consider the SPY T A or B trades. Of course, the riskier SPY T E and F trades will give you more profit, and also you need less of a move in the market for them to become profitable. However, the downside is you have less of a hedge if the market reverses overnight. There's always give and take when trading options. So again, at the end of the trading day, I take a look at my indicator, decide which ratio trade or small directional trade I wish to make, what ETF I want to consider. Generally, I like to look at the ones that are in line with the SPY but have a higher IV. Generally, the IWM has been the highest out of the 3 I tend to trade. Right after I buy my positions, I set a time for them to sell automatically. Why do I do this? Just to get out of my own way. You can sell them manually in the morning, but I find if you have trouble with day trading, you may also have trouble exiting in the morning. So I just pick a time to be consistent. And it could be at the opening at 9:30 Eastern time, but it could be 10 o'clock or 11 o'clock, noon, or 1 o'clock, depending on what you think is best for your ETF or stock. So if the market mood changes overnight due to earnings or economic reports, well, you have that hedge in place, which will help to minimize the loss of your trade, especially if there's a big move. And if the move is big enough, it's very possible that your hedge could overtake your initial position and you could make money even though the market went the opposite direction. If you have questions, put them in the comments and I'll see you in the next video.